Should you buy your first home with an ultra low deposit mortgage with a potentially zero deposit mortgage? What are the things to look out for? Is it a good idea? What if house prices crash? What if you can't afford the mortgage? What happens if you need to move within 5 years? What happens? What happens? What happens? These are all the questions that first time buyers ask when it comes to buying their first home. Because we know that from the research that the financial regulators done, that lenders have done, and because we're all normal human beings and we can obviously see that the biggest problem is getting the deposit together, that's why we end up with these ultra low deposit mortgages now being offered. And we've seen a huge raft of them over the past kind of 6 months come to market. Most notably, of course, we've got the April 100% mortgage option. We've got Leeds Building Society with 2% with a 5k minimum, the Halifax 5k deposit mortgage. We've now got a 2% option with Aldermore Bank, which is for people that have a small deposit or a modest deposit and are struggling to get to a higher level, but also have less than perfect credit histories. But is it a good idea? What happens if house prices do crash? Of course, interest rates are higher on these particular options. So how do you decide whether you should do it or you shouldn't? Well, I want to have a chat about that and actually go through some of the things you might want to consider. Because of course, the reality is, the sooner you can buy your own home, the better. Now, if you're in a position as a first-time buyer and you don't have a huge deposit saved up at the moment and you're not in a position to receive a gift from a family member, which obviously lots of people aren't, because we do know that approximately half of all people that buy as first-time buyers do get family support in way of gifts, and those gifts can be quite significant. And lenders are aware, and I think the government are aware, that it starts to create a two-tier society. I mean, we've got one of those already, but and I think they're mindful that we don't want to make that worse. So for the people that are, I guess, the ones that are thinking about, is this a good idea? I'm going to come down the side of yes, I think they are, for a very simple reason. Generally, the sooner you buy the home, of course, the sooner the mortgage is paid off. But once you do buy your home, and we know that that is the hardest step in the same way that the first gear works the hardest in a car because we have to overcome inertia. The sooner you make those payments, the sooner you can start making overpayments, the sooner you can start benefiting from any potential equity growth, the shorter period of time you're paying rent. Obviously, those are all positive things. And of course, there are now many, many options. In fact, are you even aware of how many options exist with regards to low deposits? We've got April mortgages that are 100%, Skipton Building Society that are 100% mortgage. That's based upon your rental track record. We've got Melton and Hanley Economic Building Societies with 0% deposit options. We've got the Barclays Springboard, which is not quite it is a 100% mortgage, but it's where a family member has to put, in fact, it doesn't actually have to be a family member, can put an amount of money into a savings account with Barclays. You borrow the amount and that savings is locked up for a period of time, 3 to 5 years. And they receive interest on it. They get that money back. After 5 years, you remortgage, you've built up the equity. We've then got the very low deposit mortgages. Think Halifax, Leeds Building Society, Aldermore, and Accord. There are others, of course, I can't remember them all off the top of my head, and I'm doing this off the cuff. Now, the 100% options aren't to be confused with not needing any money to buy a home. You're still going to need money for legal fees, for surveys, potentially for lender fees, and also a buffer because you don't want to be buying your first home without any money in the bank whatsoever. Things can go wrong, boilers can break, the clutch can need replacing, etc., as you're well aware. So I'm not the biggest fan of 100% mortgages personally, but I understand that for the right person, in the right circumstances, they can be a great option. Now, the one downside with those is that particularly the April mortgages option is that fixed rate is typically 10 or 15 years long. That can feel like an awfully long time to tie into. That said, it does have no early repayment charges. So if you're selling the property or paying it off from your own funds, you're not going to get slapped with a penalty. If you're wanting to remortgage away, then of course there may be a penalty to pay at that point. But it also does have a couple of other features. And whilst the interest rate is higher, as you move through loan to value banding, so you start off with 100% and you move to say, 95 and 90 and 85, etc. As your mortgage goes down, as the value of your home goes up, that interest rate does start to reduce. Even though it is fixed at the outset, so it wouldn't get worse, it can get better over time. Again, with the Skipton track record mortgage, where it's based upon your rental evidence, so you typically need to be renting for typically 12 months at least, paying the rent and the household bills, and as long as the mortgage doesn't exceed a specific amount of rent, then potentially you can borrow that amount of money, assuming you have the income to support it. I'm a bigger fan of the smaller deposit mortgages. I think it's healthy and I think it's good to have some skin in the game. That's just my personal opinion. That's not to say that it's right, but I think it's useful to have gone through gone through a period of time of trying to save, even if that takes just a couple of months to get to 2%. Now, of the low deposit options, I think there are 4 that are worth talking about: the Leeds Building Society, the Halifax, the Aldermore, and the Accord mortgage. Now, Halifax, Accord, and Leeds are 5k options. Leeds is 2%, but with a minimum of 5k. Halifax is 5k, and the Accord is 5k. The Aldermore option, which is for less than perfect credit histories, where you've had potentially CCJs or defaults, etc., or you've got a low credit score, you've had some blips, that is genuinely 2%. So 2% of 150 is, of course, 3,000 quid, or 200 grand is 4,000 pounds. That is a pure 2% option and 98% loan to value product. I think those are potentially better products for the simple reason that the interest rates are a little bit lower, whilst they're still punchy because of where we are. But I do think that they are good options if you don't have a huge amount of cash and do want to get on and buy your first home. But the biggest thing that I think is stopping people, other than interest rates and house prices where they are, and I don't think that's going to change anytime soon, is most people are worried, and this relates to house prices, and most people are worried about negative equity. What happens if I buy a home and I have almost no deposit and therefore almost no equity at the outset? What happens in that scenario if house prices have a tumble, if house prices start to fall? Now, it's a legitimate concern, of course it is, because you can find yourself in a position where you wouldn't be able to sell that property without putting in any cash, or in this scenario, because obviously the reason you would buy with a smaller deposit is because you're struggling to get that cash together, and therefore it may mean being kind of trapped. And of course, no one wants to feel trapped. But what's the likelihood of that happening, and why are people so nervous of it? Now, that I think all stems from the financial crisis back in 2007 to 2009. And I think there's lots of stuff online now where when these lenders come out with these products that are ultra high loan to value, most people you'll see in comment sections on social media jump in and say, oh, we're back in 2008 and this is all going to go wrong and blah, blah, blah. And, if you do this, you're crazy because you're setting yourself up for a fall. Now, the people that say that kind of stuff don't really understand what happened in 2008 is the truth, and don't understand the regulatory environment that we operate in today. Because if they did, they would understand that that's, broadly speaking, bollocks. The reality is that in 2008, when the financial system basically imploded and we looked like we were heading back to the dark ages, capitalism was over and money might be, basically better off stuck on walls. What caused that? What actually caused that? Well, it was mortgage lending, but it was predominantly mortgage lending in America, although there were obviously problems in the UK as well, but it was predominantly mortgage lending in America. But it was essentially a liquidity crisis. And it was a crisis because people had been lent a lot of money with no ability to pay it back. Not that they just struggled to pay it back, but they couldn't pay it back. At the outset of the mortgage, they couldn't pay it back. But lenders had very lax rules at the time in America. Anyone could get a mortgage. You could basically put down your dog's name and you'd get approved. What happened then was kind of a systemic problem through the financial crisis, because all this borrowing had taken place. That had pumped up house prices, and therefore when we kind of went to open the cupboard to see what was in there, it was bare. That meant that all the kind of the valuations of the banks, of the big kind of lenders, were basically fake. We knew that these house prices wouldn't be able to be sustained because people couldn't afford to pay the mortgages, and therefore they would have to be repossessed. And what happens when you get a lot of repossessions? You get a lot of people trying to sell all at one time. You get a fire sale, house prices come down, and that's how that happened. That then started to topple over banks, and that's when governments had to step in. That's a very, very broad and rough kind of idea of what happened. But the regulatory environment that we operate in now is completely different because of the lessons that were learned then. Which is why it's been so difficult, and which is why people find it difficult to get a mortgage, which is why people find it difficult to borrow the amount that they need, because of the regulatory changes that were brought in to ensure that that couldn't happen again. Now, when it comes to obtaining a high loan to value mortgage is, of course, there is going to be a lot of due diligence. There's bound to be on the behalf of mortgage brokers, and you'd need to bear in mind that 90% of mortgages are intermediated via mortgage brokers. So almost all mortgages in the UK go via a mortgage broker, whether that's someone like me as an independent one-man band, or whether it's one of these big online places where you don't really talk to anyone and they just kind of tap away on a keyboard. I say that a little bit kind of, I'm not a fan of them, but 90% of all mortgages go via an intermediary, which means there's a level of due diligence that's going to take place at that point. Is the income sufficient? Is this realistic? Let's have a chat about the kind of the whys and the wherefores, the risks and the benefits. Once it goes through that stage and then an application is made, it goes into an underwriting process where the lenders are going to obviously be very, very stringent with who they approve for these mortgages, because they don't want to happen what happened in the past. Now, not to mention, of course, we have now loan to income limits. We have to take into account affordability. We don't just take a salary and multiply it by 4 or 5 or 6. We have to look at what your household makeup is, how many people are in the household, how many incomes, how many children, what debts you're currently carrying, how long the mortgage term is over, how long you've been in your employment, what your credit history looks like. All those factors get taken into account to determine if they think you're going to be eligible for that mortgage, if it's going to be sustainable and affordable, and not put you in a position where they have to repossess in the future. Because actually, mortgage lenders never want to repossess. It's the last thing they want to do. 1, because it's bad PR. 2, because it costs a fortune. And 3, because they'd rather not have to do that. They just don't want to do it. They don't want to have resources to do that. So the reality is, the regulatory environment we operate in is so very different to 2007 to 2009 and the period that led up to that, that is almost impossible to happen. It's not to say it can't happen, but it would be very, very odd for it to happen. And that's actually one of the reasons why, when we saw the Liz Truss budget, mortgage rates spiked, the inflation crisis, that's one of the reasons why we didn't see mass repossessions. Because people that had mortgages, yes, it was painful when they saw their interest rate spike up from 1% to 6%. Of course, that's never going to be nice. But the reason we didn't see mass repossessions was a combination of factors. One, lenders had already done the stress testing. They, at the outset, when those mortgages were originated, maybe in kind of 2015, whenever it may have been, the stress testing that took place meant that actually, in the event of an interest rate shock, in the event of an inflation crisis, and those two things happening at the same time, actually, whilst it was awful for homeowners, and we're still reeling from that, and people have had to tighten the belts, it's not been good, of course it's not. But that's why we didn't see mass repossessions. That's why we've not seen a housing crash, because underwriting standards are so much better. Now, the second part of that is, what's the likelihood of, if house prices do have a wobble, what's the likelihood of falling into negative equity? Well, there's never going to be no risk, of course, because we don't know what can happen in the future. God forbid there was a war, an actual proper world war. That would obviously really tank the economy and therefore house prices. But to be honest, if it's a world war, we're more bothered about survival than we are probably about the value of our home. Now, one of the reasons why these ultra low deposit mortgages come with typically 5-year fixed rates, and almost exclusively they do, is because if you look back at the history of house prices and you look back at when house price corrections have occurred, how long do they occur over and how quickly do they recover? Well, it's generally, they tend not to fall over more than 1 year, so it typically tends to happen in a single 12-month period. And they tend to recover within 3 to 4 years. Now, that's not always the case, but broadly speaking, over the last 50 years, that's been true. That doesn't mean that it will be true in the future, but that's what's happened in the past. And you can go back even further than that, and generally the rule applies. So one of the reasons why they are exclusively on 5-year fixed rates, not always, but predominantly, is that if you buy a home with a very small deposit, and the day that you move in, that's when it happens. That's when the new 2008 kicks off. The reality is that by the time your mortgage comes to renewal in 5 years' time, assuming you don't need to sell in that intervening period, and you shouldn't be buying a home with one of these products unless you are certain, in my mind anyway at least, that you're going to be there for at least 5 years, because that's a meaningful period of time to build up some equity to pay down some mortgage. The reality is that you shouldn't be in negative equity by that 5-year fixed rate renewal date comes around. The second part is that, of course, let's say that you buy and then in 5 years' time, that's when house prices take a tumble. Well, in that period of time, you'll have paid down the mortgage for 5 years. House prices will have probably risen for 5 years because despite obviously us all thinking that house prices are crazy, in which they are, it's caused a lot of problems. Then again, if it happens in 5 years' time from when you bought, again, you should have built up enough equity that you shouldn't be or finding yourself in negative equity. Again, that's not to say that it can't happen. Of course it can. And there's a third part that I think also gets missed. And that is this. When the global financial crisis happened, how much did house prices fall by, on average in the UK? Well, it was approximately 17 to 19%, which is an enormous amount, of course. So whether you buy with a 2% deposit, no percent deposit, a 5 or 10 or 15% deposit, if a 2008 financial crash happened the day that you moved in, unless you've got 20% deposit or more, the reality is you're not going to be safe anyway. So when house price corrections turn up, they tend to be short and sharp, and they tend to be quite severe, but they do tend to recover quite quickly because it's essentially, a refreshing of the housing cycle, a refreshing of the economy. I say refreshing because I don't want to say a complete and utter shit show, although I've now said it. But it's a reset. It's a reset of things. And then once the reset has happened, once you've hit the brick wall, things can start to recover. So should you buy with an ultra low deposit mortgage? Well, it depends upon a couple of factors. If you're able to save up a bigger deposit, then it's always going to be beneficial because the more deposit you have, potentially the better interest rate, the smaller the amount that you're going to need to be borrowing, the lower the monthly payment. Yes, if in 6 months' time you can get to a 5 or a 10 or a 15% deposit, then of course do that. Of course, always do that. Always borrow as little as you possibly can, of course. But if you're in a position where you're paying through the nose for rent, if it's basically impossible to get on the housing ladder without using something like a 0% deposit or a 2% deposit option or a 5k option, then I would say it's a reasonable thing to do. I would certainly do it. Now, of course, you have to be skeptical, you have to be cynical because I'm biased. I'm a mortgage broker, right? If you get a mortgage and I do it, I get paid. So I've got skin in the game here, right? And you need to take that into account. That said, I am generally quite honest and, if I was a grifter, I would say that, right? But I wouldn't do this. I wouldn't put someone in that kind of position because I wouldn't be able to sleep at night, in all honesty. Whether you believe that and whether you know, that's obviously for you to decide, but I know in my own heart that that is true. So if you're in a position where you can get that deposit, then of course get the deposit together. If you're in a position where your family can gift you the deposit and help you out, then of course take that option. Who wouldn't? But if you're the person that's got good income, you're struggling to save, and you're of an age and you're secure in a relationship or your income is sufficient to be able to do this on your own, then I would say it's probably a worthwhile thing doing. Yeah, it's not ideal. Yeah, the rates are a bit punchy. Yeah, it's not going to be perfect, but you know what? Life isn't. And actually, at some point you're going to need to buy a home. And I don't think waiting around for this crash is useful, personally. That's not me trying to kind of puff the market up or anything like that. I'm well aware of where the housing market lies. I'm well aware of where the mortgage market lies. I know that we're in a period of economic precarity in the UK, just as many other advanced economies around the world are too. The reality is, the best time to buy a house was 10 years ago, and the second, and actually the best time to buy a house was 30 years ago. The second best time is probably now, because once you own your first home, it does give you a feeling of ownership, obviously because you own it, but you then do have skin in the game. It then does matter. You can then start making overpayments. You can then start benefiting from equity growth. You will then feel generally more relaxed. I remember when I bought my first home and I felt more relaxed because it was mine and no one could take it off me. As long as I could make the payments, it was mine and I could do with it as I pleased. I didn't have the worry of being turfed out by a landlord or by my rent being increased. So it does have a meaningful, beneficial psychological impact and effect on you. That's not to say that you should do it, of course. That's not to say that it's perfect. It isn't. But we know that the deposit is the biggest factor. We know that people are struggling to save. And we know that house prices are crazy, right? I would rather they were half. And if I could kind of click my fingers and have that happen, then I would. But without causing an awful lot of damage, that can't happen. And the reality is that the economic structure, the structure of the housing market, I don't think it lends itself to having a housing crash. If anything, we've had a bit of a silent crash because in real terms, house prices have fallen. Now, the one thing to take into consideration if you're thinking about buying with a very low deposit mortgage is this. How secure are you in your job? Do you have a buffer? Can you build up a buffer if you don't have one relatively quickly? Is it going to be cheaper than renting? Do you need any flexibility? And importantly, if you're in a relationship, how secure is that? Because of course, there are potentially going to be redemption penalties on these products, i.e. penalties that if you need to sell within 5 years are going to be probably quite hefty and wipe out any equity that you build up. But also, are you comfortable sitting tight for the next 5 years? Are you comfortable making overpayments? Are you able to make overpayments? If you can answer yes to most of those questions, then I think it's a meaningful and reasonable thing to do. Of course, people will disagree, and that's the beauty of free speech and free will. But I know that one of the reasons why people aren't kind of clambering over themselves at the moment is one, interest rates, and two, because of the worry of negative equity. I personally don't think that's a huge concern. I might be wrong. Hopefully, I'm not, because if I am, that means a lot of people might get hurt. But if you are considering it and you are thinking it's something you want to explore, then I would treat the skepticism you may see online with a pinch of salt, because it's predicated on people not really understanding the financial crisis. We're in a different regulatory environment. And you know what? If it's going to take you 5 years to save the deposit, you're probably better off just getting in now. That's all for me today. And of course, if you do want to work with me, I'll pop a link in the bio. There's a page there that takes you to how I work, what you can expect, how to book an appointment, all that kind of jazz. Thanks for being with me today. And I'm going to start doing some more of these videos and talking about the housing market, mortgage market, the economy more broadly. And thanks for watching. Take care.